Friends, thank you for being here today. What if I told you that 18,000 homes are sitting on the market and no one is buying them? What if the invisible hand that kept Canadian real estate climbing for 2 decades has just let go? Right now, across the Greater Toronto Area, we are watching the unraveling of the largest speculative bubble in Canadian housing history. And the numbers don't lie. They whisper a mathematical truth that most people refuse to hear. The exit doors are jammed, the sellers are panicking, and the entire edifice is beginning to crumble. Let me give you the scale of what we're facing. In January 2026, there were approximately 17,975 active listings in the Greater Toronto Area. That's an 8.1% surge compared to the previous year. Meanwhile, home sales cratered by nearly 20%, dropping to just 3,082 units. This is not a correction. This is not a seasonal adjustment. This is one of the weakest starts to the year in recent history, and it marks the beginning of what I call the inventory wall, a structural fault line that will determine the fate of hundreds of thousands of Canadian families over the next decade. For the first time in years, the average selling price in the GTA has fallen below $1 million, landing at $973,080, down 6.5% year over year. But that number hides the real story, because when you drill down into the condo segment, the picture becomes far more disturbing. Condo apartment prices are down 9.8% year over year, nearly 10%. And for the thousands of investors holding pre-construction contracts, for the speculators who bought at the peak with the promise of assignment profits, for the ordinary families who stretched themselves to afford a unit they hoped would appreciate, this is not just a price drop. This is a liquidity crisis. This is a mathematical endgame. Now, you might be asking, why is this happening? Why now? The answer lies not in today's headlines, but in a system that was architected decades ago to ensure that real estate could only go in one direction. To understand the collapse we're witnessing, we need to go back to the origin, to the Genesis myth of the Canadian housing market. In the 1990s and early 2000s, Canada made a deliberate policy choice. The government decided that housing would become the engine of economic growth. Immigration targets were raised, interest rates were suppressed, foreign capital was welcomed without question, and the result was predictable. Prices began to climb, not because of fundamental demand, but because of liquidity, an endless river of cheap credit flowing into concrete and glass towers across Toronto, Vancouver, and every major city in between. Think of it like this. Imagine you could borrow money at near zero interest rates to buy an asset that the government had implicitly promised would never decline in value. You don't even need to live in it. You just need to hold it long enough for someone else to pay more than you did. That's the carry trade in real estate. That's the scaffolding that held up the entire market. And now that scaffolding is snapping. Here's the mechanism simplified. For years, Canadian banks lent money to buyers at historically low rates. Those buyers, many of them investors, purchased condos, often in pre-construction, with the intention of flipping them before they were even built. This created what's called the assignment market, a shadow economy where contracts changed hands multiple times before a single brick was laid. Developers loved it because it gave them upfront capital. Banks loved it because it generated fees, and investors loved it because it seemed like free money. But there was one problem. The entire system depended on prices continuing to rise. When interest rates were at 2%, when mortgage stress tests were lenient, when immigration was bringing in 500,000 people a year, the math worked. But in 2024 and 2025, the Bank of Canada raised rates aggressively to combat inflation. Suddenly, the monthly carrying cost of a condo doubled. The stress test requirements tightened. And the buyers, the end users who were supposed to absorb all this supply, they vanished because they couldn't afford it anymore. This leads us to the system's most crucial secret. which we will explore in detail. The difference between paper wealth and real liquidity. For years, condo owners in Toronto looked at their statements and saw their net worth climbing. On paper, they were millionaires, but paper wealth is not the same as cash. Paper wealth evaporates the moment you try to sell, and there's no buyer on the other side. And right now, across the GTA, there are 18,000 sellers and almost no buyers. Let me show you the evidence. In 2025, the GTA reported 62,433 home sales, the lowest annual total since the year 2000. Read that again, the lowest in a quarter century. Meanwhile, new listings surged to record levels. Active listings at year-end 2025 were the highest since the 2008 financial crisis. The months of supply, a key metric that measures how long it would take to sell all available homes at the current pace, averaged 4.9 months in 2025. Anything above 4 months signals a buyer's market. We are now firmly in that territory. But here's where it gets truly dangerous. The condo segment is not just soft, it is imploding. During the third quarter of 2025, condo prices in Toronto were down 6.4% year over year. Active condo listings grew faster than transactions. And according to the Toronto Regional Real Estate Board, buyers now have more negotiating leverage in the condo segment than in any other housing type. What does that mean in plain English? It means sellers are desperate, it means prices are falling, and it means the thousands of investors who bought pre-construction units hoping to flip them for a profit are now staring at a nightmare scenario. They are holding contracts they cannot assign. They are facing closing dates on properties worth less than what they agreed to pay. And their only options are to close, absorbing a massive loss, or to walk away, forfeiting their deposits. For many, walking away is the rational choice. And when those deposits are forfeited, when those contracts are canceled, that inventory doesn't disappear. It becomes the developer's problem. And eventually, it floods back onto the market, adding to the already staggering oversupply. This is what I call the shadow inventory, the hidden supply that hasn't hit the MLS yet, but will. It's the tens of thousands of units currently under construction that were pre-sold to investors who can no longer close. It's the assignment contracts that are sitting in limbo with sellers trying to offload them at any price. It's the newly completed condos that sit empty because the original buyer walked away and the developer is now scrambling to find a new purchaser. This shadow inventory is real, it is massive, and it is about to cascade onto the market over the next 18 to 24 months. Now, some of you might be thinking, surely the government will step in. Surely they'll cut rates, loosen lending standards, do something to prop up the market. And you're right, they might try. But here's the problem. The tools that worked in 2008, in 2015, in 2020, they're not going to work this time. Because the issue is not liquidity. The issue is affordability. The issue is that prices have detached so far from incomes that even with lower rates, the average family cannot afford to buy. And until prices fall to a level where they align with real wages, this market will not stabilize. Let me give you a concrete example. In central Toronto, the average condo price is still hovering around $700,000 to $800,000, depending on the neighborhood. To qualify for a mortgage on a $750,000 condo at today's rates, you need a household income of approximately $150,000 per year. That's the top 20% of earners in Canada. But the buyers who are supposed to absorb this supply, the young professionals, the new immigrants, the first-time homeowners, they're not making $150,000 a year. They're making $60,000, $70,000, maybe $80,000. The math doesn't work, and no amount of rate cuts will bridge that gap unless prices collapse by 30% to 40%. This is the ugly truth that no one in the real estate industry wants to admit. The market is not experiencing a temporary slowdown. It is undergoing a fundamental repricing, and that repricing is being driven by a simple, brutal reality. There are too many condos and not enough people who can afford to buy them. Let me show you the canaries in the coal mine. In late 2025 and early 2026, we started seeing the first wave of distressed sales. Individual investors who had purchased multiple pre-construction units began quietly trying to offload them. Some succeeded, but at steep discounts, 10%, 15%, even 20% below their purchase price. Others couldn't find buyers at any price, and so they walked away, forfeiting deposits of 50,000, 100,000, sometimes more. One case that caught my attention involved a group of investors who had purchased an entire floor of a condo building in the entertainment district. They had planned to flip the units on assignment before closing, but when the market turned, they couldn't find buyers. They tried lowering the price, they tried offering incentives, nothing worked. In the end, they walked away, forfeiting over $2 million in combined deposits. That money is gone, vaporized, and the units are now back on the market, adding to the glut. This is not an isolated incident. This is happening across the GTA, and it's not just small-time investors. We're seeing institutional players, the REITs, the pension funds, the private equity groups that piled into Canadian real estate over the past decade. We're seeing them quietly exit positions. They're not announcing it. They're not issuing press releases, but they're selling. And when the big money starts heading for the exits, that's when you know the party is over. Now, let's talk about the trigger event, the specific moment when the system began to fracture. In late 2024 and early 2025, the Bank of Canada held interest rates at elevated levels far longer than the market expected. The overnight rate stayed above 4% for months. And while that might not sound dramatic, the effect on mortgage holders was catastrophic. Remember, in Canada, most mortgages are not 30-year fixed rates like in the United States. They're variable or short-term fixed, typically renewing every 5 years. And when those renewals came due in 2024 and 2025, homeowners faced payment increases of 40%, 50%, sometimes 60%. For condo investors, the situation was even worse because condos have maintenance fees on top of mortgage payments. In Toronto, the average condo fee is now over $600 per month. Add in property taxes, insurance, and utilities, and the carrying cost of an average one-bedroom condo can easily exceed $3,000 per month. If you're renting it out, you might collect $2,200, maybe $2,400 in rent. That's a negative cash flow of $600 to $800 every single month. Multiply that across thousands of investor-owned units, and you begin to understand why the exit has begun. But the interest rate shock was only the first domino. The second domino was immigration policy. In late 2024, the Canadian government announced a dramatic reduction in immigration targets for 2025 and 2026. After years of bringing in 500,000 new residents annually, the new targets were slashed to around 395,000. On the surface, that still sounds like a lot. But here's the problem. The entire demand model for Toronto condos was built on the assumption that immigration would continue at record levels indefinitely. Developers had pre-sold tens of thousands of units based on that assumption. Investors had bought on that assumption. And when the policy changed, the floor dropped out from under the market. Think about what this means. For every 100,000 fewer immigrants, that's 30,000 to 40,000 fewer households looking for housing. In a market that was already oversupplied, this was the equivalent of removing the only source of incremental demand. And the impact was immediate. Rental vacancy rates began to tick up. Condo rental listings flooded platforms like rentals.ca and Kijiji, and landlords, desperate to avoid vacancies, started cutting rents. In some buildings, one-bedroom units that were renting for $2,500 in 2023 were now going for $2,100 or $2,200. That's a 15% decline in rental income, which directly impacts the cash flow calculation for every investor. Now, here's where it gets truly insidious, because at the same time that carrying costs were exploding and rental income was falling, the ability to sell these properties evaporated. The resale market for condos in Toronto has effectively frozen. And I want to be very specific about what I mean by frozen. I don't mean prices are stagnant. I mean transactions have collapsed. In January 2026, total home sales in the GTA were just 3,082 units. To put that in perspective, in a typical January during the boom years, sales would be around 5,000 to 6,000 units. We're down nearly 40% from normal levels. And within the condo segment specifically, the numbers are even worse. Let me give you a forensic example, the kind of insider detail that tells you exactly how bad things have become. In the Liberty Village neighborhood, one of Toronto's most densely developed condo districts, there is a building called Apex Condos. It's a mid-tier tower, nothing fancy, built around 2018. In late 2025, there were 14 units listed for sale in that single building. 14 units out of maybe 400 total. That's 3.5% of the building trying to exit at the same time. And here's the kicker. After 6 months, only 2 of those units had sold. The other 12 are still sitting there, with prices being cut every few weeks. One unit, a 600 square foot one-bedroom, was originally listed at $620,000. It's now listed at $549,000. That's a $71,000 price cut and still no buyer. This is the reality on the ground, and it's not unique to Liberty Village. The same pattern is playing out in City Place, in King West, in the entertainment district, in every condo-heavy neighborhood across Toronto. Sellers are trapped. They can't get their price. They can't find buyers. And the longer they wait, the worse it gets, because every month more supply hits the market as new buildings complete and as more investors throw in the towel. But the most toxic part of this entire mess is the assignment market. Let me explain how this works, because this is where the real bloodbath is happening. When you buy a pre-construction condo, you're not buying a physical property. You're buying a contract, an agreement to purchase the unit when it's completed, which could be 3, 4, or 5 years in the future. In the boom years, investors would buy these contracts with a relatively small deposit, maybe 15% to 20% of the purchase price. Then, before the building was finished, they would flip the contract to someone else for a profit. This is called an assignment sale, and it was incredibly lucrative when prices were rising 10% or 15% per year. But now, prices are falling. And when you try to assign a contract for a unit that's worth less than the contract price, there are no buyers. None. Because why would anyone agree to pay $700,000 for a condo that's currently worth $650,000 on the open market? They wouldn't. They'd just go buy a resale unit and save $50,000. And so the assignment market has completely collapsed. According to some estimates, there are thousands of assignment contracts in the GTA right now that are effectively worthless. The sellers are holding deposits totaling tens of millions of dollars, and they're facing a binary choice: close on the unit and absorb the loss, or walk away and lose the deposit. For many, walking away is the rational decision. If you put down a $100,000 deposit on a $700,000 condo, and that condo is now worth $650,000, you're looking at a $50,000 loss if you close, plus the transaction costs, plus the carrying costs until you can sell it. Your total loss could be $80,000 or $90,000. But if you walk away, your loss is capped at the $100,000 deposit. It's still devastating, but it's the lesser of two evils. And thousands of investors are making that calculation right now. This is what I mean by the shadow inventory. These are units that are going to come back onto the market, either because the developer has to resell them after a contract cancellation, or because the investor closes and immediately lists the property at a loss just to get out. Either way, that supply is coming. And when it does, it will drive prices even lower, creating a vicious cycle of falling prices, more cancellations, and more distressed sales. Now, some of you might be thinking, okay, but what about the people who aren't investors? What about the ordinary families who bought condos to live in? Aren't they insulated from this? And the answer is not really. Because when prices fall, everyone's equity disappears, not just the speculators. If you bought a condo in 2022 for $750,000 with a 10% down payment, you put $75,000 down and borrowed $675,000. If that condo is now worth $675,000, your equity is gone. You're at break even. And if prices fall another 5% or 10%, you're underwater. You owe more than the property is worth. In the United States, they call this being upside down on your mortgage, and it's a psychological trap because once you're underwater, you can't sell without bringing cash to the table to pay off the difference. And most people don't have that cash, so they're stuck. They have to keep making the payments, even if the property is bleeding value, even if they want to move, even if their financial situation has changed. This is how a real estate downturn turns into a multi-year stagnation. People stop moving, transactions freeze, and the market enters a state of paralysis. Let me show you another canary, this one from the new construction side. There's a developer in Mississauga, just outside Toronto, who launched a condo project in 2021. They pre-sold about 80% of the units, mostly to investors. The building was supposed to complete in late 2025, but as the market turned, the developer started getting cancellations. First a trickle, then a flood. By the time the building was finished, nearly 30% of the original buyers had walked away. The developer tried to resell those units, but the demand wasn't there. So they're now sitting on $40 million worth of unsold inventory in a completed building. They're paying interest on their construction loan. They're paying property taxes. They're burning cash every month. And they can't move the units because the market is saturated. This is not a small developer. This is a mid-sized firm that's been building in the GTA for 20 years. And they're not alone. Across the region, developers are facing the same problem. They built for a market that no longer exists. They pre-sold to buyers who can't or won't close. And now they're stuck holding inventory that's declining in value. And here's the terrifying part. This problem is not confined to condos. It's spreading. In the broader GTA housing market, prices are down across the board. Detached homes, townhouses, semi-detached properties, they're all seeing declines. In January 2026, the average selling price for all home types was $973,289, down 6.5% year over year. That might not sound catastrophic, but remember, this is after years of prices doubling and tripling. A 6.5% decline after a 100% or 200% gain is the beginning of the unwind, not the end. And if history is any guide, once prices start falling, they tend to overshoot on the downside, just as they overshot on the upside. Let me put this in terms that are easy to visualize. Imagine a stadium filled with 18,000 people and there are only two exits. Now imagine someone yells fire and everyone tries to leave at once. What happens? Chaos, panic, trampling. That's the GTA housing market right now. There are 18,000 active listings and only a handful of buyers. Everyone is trying to get out at the same time, and the exits are jammed. So let me ask you, where do you hide? Stocks. The equity markets are draining liquidity as central banks tighten. Bonds, yields are rising, which means bond prices are falling. Cash, inflation is eroding its purchasing power every single day. The traditional playbook, the advice that worked for the past 40 years, it's not working anymore. The liquidity tide is going out, and we are about to find out who has been swimming naked. But before we get to the solution, before we talk about what you can do to protect yourself, We need to understand the broader forces at play because this is not just about Toronto condos. This is about a global debt system that has reached its breaking point. This is about central banks that have painted themselves into a corner. This is about a convergence of forces that is happening right now in real time, and most people are completely blind to it. We are facing a convergence. Three distinct forces are hitting at the exact same moment, and together they create a perfect storm that will reshape the Canadian housing market for a generation. Let me lay them out clearly. Force number one, the structural break in the investor model. For 2 decades, the Toronto condo market was sustained by a simple equation. Buy a pre-construction unit with borrowed money, hold it for a few years, and sell it for a profit. This worked because prices always went up, because interest rates were always low, and because there was always a greater fool willing to pay more. But that equation has now reversed. Prices are falling. Interest rates are high, and the pool of buyers has evaporated. The investor model is broken, and it's not coming back. Not in this cycle, not for years. Force number two, the domestic liquidity crisis. The Bank of Canada is stuck between two impossible choices. If they cut rates aggressively to support the housing market, inflation will reignite. Food prices, energy prices, the cost of living will spiral higher, and Canadians will revolt. But if they keep rates elevated, the housing market will continue to collapse, taking consumer confidence, household wealth, and eventually the banking system down with it. They are trapped, and trapped central banks make mistakes, big mistakes. Force number three, the demographic and policy reversal. For years, Canada's immigration policy was the backstop for housing demand. The government imported hundreds of thousands of people annually, and those people needed somewhere to live. That created a floor under the market, but that floor has been pulled away. Immigration targets have been slashed. International student visa approvals have been tightened, and the temporary residents who make up a significant portion of rental demand are being asked to leave. The structural demand driver that underpinned the entire housing boom is now working in reverse. These three forces are not independent, they are interconnected, and they are reinforcing each other in a downward spiral. Falling prices lead to more investor exits. More exits lead to more supply. More supply leads to lower prices. And lower prices lead to more cancellations, more distressed sales, and more panic. This is what a negative feedback loop looks like. And once it starts, it is very, very difficult to stop. Now, here's the part that most people don't understand, the psychological dimension of this crisis. Human beings are hardwired to believe that tomorrow will look like yesterday. It's called normalcy bias. We assume that the patterns we've experienced will continue. And for Canadians who have lived through 2 decades of rising home prices, the idea that real estate could fall 20%, 30%, or even 40% is almost unthinkable. It doesn't compute. And so they wait, they hold on, they refuse to sell at a loss because they believe the market will bounce back. They believe that if they just wait a little longer, prices will recover and they'll be made whole. But what if they don't? What if this is not a temporary dip, but a permanent repricing? What if the market of 2019, 2020, 2021, the peak years, what if that was the anomaly and what we're returning to now is normal? That's the truth that no one wants to face. Because if you accept that reality, you have to accept that the wealth you thought you had, the equity in your home, the paper gains you were counting on to fund your retirement or your children's education, it's gone. Not temporarily, permanently. This is the money illusion in its purest form. You look at your net worth on paper and you see a big number. You feel rich. You make spending decisions based on that number. You borrow against it. You plan your life around it. But the moment you try to convert that paper wealth into actual cash, into real liquidity, you discover that the number was a mirage. because your net worth is only as real as the price someone is willing to pay. And right now in the Toronto condo market, no one is willing to pay. Let me give you a concrete example of how devastating this psychological trap can be. Imagine you bought a condo in 2021 for $800,000. At the peak in early 2022, your neighbor's identical unit sold for $850,000. On paper, you made $50,000 in less than a year. You felt like a genius. You started thinking about upgrading, maybe buying a second property, but you didn't sell because why would you? Prices were going to keep going up, right? Fast forward to 2026, your condo is now worth $720,000. You've lost $80,000 in equity. And worse, you can't sell because there are 5 other units in your building listed at the same price, and none of them are moving. You're stuck. And every month you're paying $3,200 in carrying costs for an asset that's bleeding value. This is not a hypothetical. This is the reality for tens of thousands of condo owners in the GTA right now. And the psychological damage is profound because once you've experienced a loss like that, once you've watched your net worth evaporate, you become risk averse. You stop spending, you stop investing, you hunker down. And when millions of people do that at the same time, the entire economy slows. Consumer confidence craters, retail sales fall, businesses lay off workers, and the downward spiral accelerates. Now, let me be very clear about something. I am not rooting for this. I take no pleasure in describing this nightmare scenario. There are real people on the other side of these numbers. Families who saved for years to afford a down payment. Young professionals who believed they were building a future. Immigrants who came to Canada with dreams of home ownership. These are not reckless speculators. These are ordinary people who were told by the government, by the banks, by the real estate industry, that buying a home was a safe, smart investment. And they were lied to. But the system doesn't care about fairness. The system doesn't care about your intentions or your hard work. The system cares about mathematics. And the mathematics of the Toronto housing market are now working against you. So the question is, what do you do? This is the binary choice that every person watching this video needs to make. Do you own real assets or do you own claims on assets? Do you own things that have intrinsic value or do you own pieces of paper that promise you value? Because in a crisis, that distinction becomes everything. Let me break this down. When you own a condo, what do you actually own? You own a piece of a building that sits on land. But in a high-rise condo, your share of the land is minuscule. You're buying air. You're buying a spot in the sky. And if that building is in a market with 18,000 competing listings, your claim on that spot is only worth what someone else will pay for it, which, as we've established, is increasingly little. But what if you own something different? What if you owned gold? Gold is not a claim on value. It is value. It's a physical asset that has been recognized as money for 5,000 years. It doesn't depend on a buyer being there when you need to sell. It doesn't depend on a functioning market. It doesn't depend on anything except the laws of physics. And in a world where paper assets are vaporizing, where the liquidity tide is receding, gold is the ultimate safe harbor. Now I can already hear the objections. Gold doesn't produce cash flow. It doesn't pay dividends. It just sits there. And you're right. Gold is not an investment. It's insurance. It's a hedge against the failure of the monetary system. It's a way to step out of the line of fire while the great repricing unfolds. And right now, with central banks trapped, with debt levels at historic highs, with real estate markets cracking across the Western world, the case for holding gold has never been stronger. The same logic applies to silver, to physical precious metals in general. These are assets that cannot be printed. They cannot be devalued by a central bank decision. They cannot be inflated away. They are finite, scarce, and universally recognized as stores of value. And in a crisis, when confidence in paper currencies and paper assets collapses, they are what people flee to. But here's the key: you have to act before the crisis becomes obvious to everyone else. Because once the panic starts, once the exits are clogged with desperate sellers, it's too late. The time to buy fire insurance is not when your house is already burning. It's when everything seems calm, when your neighbors think you're being paranoid, when the normalcy bias is still strong. That's when you act. Let me tell you what I think is going to happen over the next 12 to 24 months. I think the Toronto condo market is going to fall another 15% to 20% from current levels. I think we're going to see mass cancellations of pre-construction contracts. I think developers are going to go bankrupt. I think there's going to be a wave of forced sales, either from over-leveraged investors or from lenders foreclosing on properties. And I think the broader GTA housing market is going to follow condos down, because once the psychology shifts, once people stop believing that real estate only goes up, the entire edifice crumbles. And here's the part that should terrify you: the government cannot stop this. They can try. They can cut rates. They can loosen lending standards. They can inject liquidity. But none of that will work if people can't afford to buy, and they can't. The average household income in Toronto is around $90,000. The average home price, even after the decline, is still close to $1 million. That's a price to income ratio of more than 10 to 1. Historically, sustainable ratios are around 3 to 1 or 4 to 1. We are so far beyond sustainable that no amount of tinkering will fix it. Prices have to fall a lot, and they will. But this is not just a Toronto story. This is not just a Canadian story. This is happening in Australia, in New Zealand, in parts of the United States, in the UK. Everywhere that central banks suppressed interest rates for a decade, everywhere that housing became financialized, everywhere that speculation replaced genuine demand, the same pattern is emerging: oversupply, collapsing transactions, falling prices. The global real estate bubble is deflating, and Canada, because it inflated the most, is going to deflate the hardest. So let me leave you with this: the window for preparation is closing, not closed, but closing. If you own multiple investment properties, if you're sitting on pre-construction contracts, you know you can't close. If you're underwater on a condo and bleeding cash every month, you need to make a decision. You can hold on, hope for a miracle, and watch your losses compound. Or you can cut your losses now, take the pain, and move into assets that are real, that are liquid, that are not dependent on finding a buyer in a collapsing market. And if you're someone who doesn't own real estate yet, if you've been priced out for years and you're wondering if you should jump in now that prices are falling, my advice is simple: wait. This is not the bottom, not even close. The sellers are still in denial. The forced sales haven't started yet. The shadow inventory hasn't hit the market. When it does, when the real distress begins, that's when you'll see true capitulation. That's when properties that were $800,000 will sell for $600,000. That's when the opportunities will appear. But in the meantime, protect yourself. Hold cash, hold gold, hold assets that preserve purchasing power, because the reset is coming. Not tomorrow, not next week, but it's coming. And when it arrives, the people who prepared will be the ones who survive. History favors the prepared, and the window for preparation is closing. Friends, I know this is heavy. I know it's difficult to hear, but the truth is not always comfortable. The truth is that we are living through the unraveling of the largest credit bubble in Canadian history, and the choices you make in the next 6 to 12 months will determine whether you emerge from this crisis intact or broken. So choose wisely, think clearly, and whatever you do, don't let normalcy bias convince you that everything will be fine, because it won't, not this time. The inventory wall is real. The math is unforgiving, and the clock is ticking. Thank you for being here today, friends. Stay vigilant, stay prepared, and I'll see you in the next one.